Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special investing report on news that Dominion Finance is likely to ask for a moratorium on debt payments and interest payments for investors with almost $250 million invested in these two finance companies, Dominion Finance and North-South Finance. It seems it's having problems getting money out of residential property developers that it's lent money to, and its debenture reinvestment rate was down at 25%. So it had a problem. It couldn't get money back from the property developers it had lent to, but it had to pay money back to the debenture holders who'd invested in Dominion Finance and North-South Finance. One of the biggest problems was that it had a big loan to a residential property developer in Queenstown, $26.3 million. That's almost 6% of its entire loan book. And really it's been hit by the downturn in the residential property market, particularly for resort properties and investment properties where there's virtually no activity happening at the moment. Volumes for overall property sales are down 50%, but in that investment area and in the resort area, particularly in Queenstown, it's virtually nil. So there's a real problem here for finance companies who have financed residential property developments. Essentially the money go round has stopped, where previously the whole deal was based on very quick sale of the apartment or the residential property development, and the developer could then refinance a loan they had originally gotten from a finance company, either to a bank or another finance company. Now the banks aren't picking up that parcel as it's being passed along. So this really is a surprise, because Dominion Finance said in May it only needed to get back 38% of the money it had lent out to property developers to be able to pay back all the debenture investors as their debentures matured. It's also a big blow for stock market investors. As you can see here from this chart, Dominion Finance was initially seen as one of the more successful finance companies, and its shares rose to $2.40 a share as recently as midway through last year. Then the credit crunch hit, and since then its shares have been down on a downward trend to 50 cents now, and that's really hurt investors. And there's some pretty high profile investors there too. Terry and Ann Butler were the driving forces behind Dominion Finance, and they have a 61% share in it. They bought it in 1987 and have built it up over that time. Elsewhere, Alan Hubbard, the very well-known South Island investor and philanthropist, he and South Canterbury Finance had a combined stake of 8%. Even the ACC, very respected institutional investor, had 1.7% of Dominion Finance. So what happens now? We'll have to wait for the actual details in the moratorium deal likely to be done, involving the trustees and the banks for the Dominion Finance group. The banks are Halifax Bank of Scotland and ASB. They're both owed about $90 million. And the trustees are a Perpetual trustee and Covenant trustee. Remember, Perpetual decided not to grant a moratorium for Lombard Finance a couple of months ago, so we'll see how that goes. Moratoriums have been used a lot more lately. Both Geneva Finance and MFS Finance successfully used them to give themselves time to restructure. But this is overall a big blow for the sector and reinforces the two-tier nature of the sector. On the one hand, we've got investment grade finance companies, and they include UDC, Merrick Finance and South Canterbury Finance. And on the other hand, we've got the non-investment grade finance companies, and they include now Hanover, Strategic, Dorchester Pacific and St. Lawrence. Really, there's some tough times ahead for finance companies, and particularly those ones exposed to the residential property development sector. I'm Bernard Hickey for interest.co.nz. That was a special investing report.